Good morning. Morning. I'm Herman Berliner, Hofstra University's Provost and Senior Vice President for Academic Affairs. It's my pleasure to welcome you to this convocation, which will be the conferral of a Hofstra University Presidential Medal on Robert F. Engle, Dr. Robert F. Engle. If you're looking for an effective answer, a perfect answer to the headline on the cover of Business Week last week, "What good are economists anyhow?" Our medal recipient today is the perfect answer in terms of the important work that he's done. To begin this convocation, it's my pleasure to introduce the president of Hofstra University, President Stuart Rabinowitz.
Thank you, Herman. I agree that if any economist is any good, it's Robert Engle. So I just simply want to add my welcome to all the faculty, and I'm delighted to see all the students here this morning, and of course our guest speaker, the man of the moment, Dr. Robert Engle. I want to thank those who are responsible for this event, and particularly I want to thank Dr. K. I will no sooner try to pronounce Dr. K's last name than I will try to tell you what ARCH stands for exactly. But Dr. K is a great faculty member in the finance department. He's distinguished, and he really helped organize this event and make it possible. I also want to thank the event sponsors, particularly the great Zarb School of Business, Hofstra Quants and Traders, the Global Association of Risk Professionals at Hofstra University, and the FMA at Hofstra Financial Management Association, Hofstra Chapter. Today's lecture is really a rare opportunity, and I'm just excited and delighted to be here because you don't often get the opportunity to listen to a Nobel laureate and a world-renowned scholar about a very, very important topic, and that's what we're about to have today. You're going to learn more about Dr. Engle's distinguished career in one moment from the dean of the Zarb School, Sal Sedano. But it is first my privilege, after Sal introduces him. This is not my speech. Am I okay. Thank you. In payment for that, I'm going to try to pronounce your last name. But I get the opportunity to confer on Dr. Engle in the moment the Hofstra Presidential Medal. And this really is one of the most prestigious awards that the university ever gives. And it is given in recognition of outstanding career achievement and academic and scholarly excellence. And among the recipients are other Nobel laureates, political dignitaries, government leaders, world leaders, award-winning authors and journalists, corporate leaders and educators, etc. And each one of them, each winner of the Presidential Medal, like you, Dr. Engle, are outstanding individuals whose accomplishments have truly earned them a place in history. The past recipients include such people as Henry Kissinger, Jeane Kirkpatrick, Elie Wiesel, Claire Booth Luce, John Kenneth Galbraith, Saul Bellow, James Watson, etc., etc. And then after the award ceremony, I just want to sit down and listen to how to invest my money on the volatility of the financial markets. So Dr. Engle, I welcome you to Hofstra University. I hope this won't be your last visit. I thank you for joining us. And I now ask Dean Sedano to come up and present you, introduce you and present you for a Hofstra Presidential Medal. Sal Sedano.
Thank you, Stuart, and good morning, everyone. I am pleased and honored to have the opportunity to introduce our distinguished guest and Nobel laureate, Dr. Robert Engle. Dr. Engle is the Michael Armellino Professor of Finance at New York University Stern School of Business, as well as the Chancellor's Associates Professor of Economics at the University of California at San Diego. Dr. Engle is a Fellow of the American Academy of Arts and Sciences, the Econometric Society, the American Statistical Association, and the American Finance Association. He is also a member of the United States National Academy of Sciences. Dr. Engle was awarded the 2003 Bank of Sweden Prize in economic sciences in memory of Alfred Nobel for his work in methods of analyzing economic time series with time-varying volatility, also known as ARCH. Thank God it's a lot easier to say that. Dr. Engle shared this honor with Clive W.J. Granger of the University of California at San Diego. In addition to ARCH, Dr. Engle's research has introduced some of the most influential concepts in modern econometrics. In 4 books and well over 100 academic journal articles, Dr. Engle has applied these methods to analyze equities, options, currencies, and interest rates. His current research also includes an investigation of the empirical market microstructure. Dr. Engle is also a frequent speaker and consultant for various financial institutions. Dr. Engle holds a Ph.D. in economics and an MS in physics from Cornell University and is principal of Robert F. Engle Econometric Services. Before joining the University of California at San Diego, Dr. Engle was an associate professor of economics at MIT. I'd like to thank Dr. Engle for accepting Dr. Ahmet Karagazoglu, I got that in there, invitation to
Twice, very fast.
Karagazoglu, invitation to join us today. Thank you, Rob. Mr. President, I recommend now that you confer the Hofstra Presidential Medal to Dr. Robert Engle.
It is our distinct honor on behalf of the Board of Trustees, the faculty, the students, the staff of Hofstra University to confer upon you the Hofstra Presidential Medal. Congratulations, Dr. Engle.
Oh, Mr. President, Dean Salzano, Mr. Provost, students, faculty, it's a great honor for me to be here. I was trying to think of the last time I was at Hofstra. It was actually when I was an undergraduate lacrosse player, and we came to Hofstra, and I think we got beat up. But I don't remember it very well, so it's great to be here today and to see all of you. It's an interesting time to be talking about financial markets. And it's an interesting time especially to be talking about financial market volatility because we have plenty of that to go around. And so what I'd like to talk about a little bit today is what we see when we look at financial market volatility and how do we interpret that and how does it compare with other things we've seen in the past and where do we think this is, where are we going? And how do we understand this? So I'd like to begin with some sort of general ideas as to why we might be interested in financial market volatility. And basically it's because of risk. A risk is some bad thing that might happen in the future. And yet there are some risks that we decide are worth taking. We don't avoid every risk that we possibly can. And so the question of when we decide it's worth taking a risk and when we decide not to take this risk is central to all of our daily lives, but especially in finance. And the question of which risks are worth taking is really a central feature of the study of finance. In fact, this is a long-standing question in finance and has received already many Nobel Prizes. Markowitz and Sharpe and Tobin all received Nobel Prizes for important contributions where they identified the risk in a financial market with the volatility of that financial market, the possibility that the prices would change a lot. And in fact, Sharpe gave the first answer to the question of which risks are worth taking in his capital asset pricing model, which also received the Nobel Prize. In that case, the answer was the simple wisdom that we should only hold diversified portfolios because the risk of idiosyncratic moves, that is, of individual stocks and so forth, would not be rewarded in the market as long as the agents all agreed that risk and volatility were the same thing. So we see the first answer to which risks should you take or which risks should you ignore is really the question of whether you ought to hold diversified portfolios. So that's a pretty deep finding, and it's been around a long time, and you've all seen it in your courses over and over again, and we teach it over and over again, but it doesn't necessarily mean it's the last word on these questions. Another important contribution is the Black-Scholes option pricing formula, for which Myron Scholes and Bob Merton received the Nobel Prize. Because we can think about options as also ways of measuring risk. An option is like an insurance contract. We can insure our financial portfolio by paying a certain premium, and that will guarantee that it won't fall below some pre-specified value, much like fire insurance or earthquake insurance. So the question then remains, what is the price for this insurance? And that's a way of measuring the risk. And it turns out that the famous Black and Scholes model made some strong assumptions about what the underlying process of stock prices really is, and could derive based on that the price of an option. And that basis is basically depends on the volatility. So financial market volatility is again the main source of risk in the Black-Scholes model. But when practitioners decided it was time to try to put these models into practice, they discovered an unfortunate fact, which students, maybe not here, but in many cases don't realize. In an exam, you always give the student what the volatilities are and what the correlations are, but in reality, you have to measure them. And when you start to measure them, it turns out they're not constant over time. Sometimes the volatility is one thing and other times it's another thing, and which one is really right? And how should you go about measuring it? What you'd like to know is, what's the volatility right now? Or maybe even better, you'd like to know, what's it going to be in the future? So that when we make our portfolio decisions and decide which risks to take, it is based on future volatilities. And how can we forecast something that we never really observe? So this is the set of questions that the ARCH model was designed to answer. And you may notice on here, I don't even tell you what ARCH stands for, but since it's come up, we might as well give it a run. It stands for autoregressive conditional heteroscedasticity. And you can probably see why people don't talk about autoregressive conditional heteroscedasticity. They just talk about ARCH. But people pay a lot of money to go to graduate school and learn how to say autoregressive conditional heteroscedasticity. So I actually have my students practice so that they really feel like they've accomplished something when they finish either the MBA or the Ph.D. program at Stern. So, you know, you might save yourself some money by practicing on your own. I don't know whether it really you can accomplish that or not. But anyway, what is this model anyway, and how does it work? It's based on two features of financial data. One is called volatility clustering, which means that financial markets, when they're volatile, stay volatile for a while. And when they're quiet, they stay quiet for a while. And you can see this in the data sets from any kind of financial market. And secondly, volatility tends to mean revert, which means when it's high, it tends to come down, and when it's low, it tends to go up. So these two features lead you to very simple models, which are statistical or time series kinds of models, which tell you how fast these things are likely to happen and what you think is the future volatility that you might expect. Well, as you heard, this got me a front row seat in Stockholm a few years ago. And you see me sitting there with my friend Clive Granger, sort of wondering about this comment, your life will never be the same, and what really was in store for us after the ceremony. But I can assure you that most people weren't watching us. They were watching the Swedish royal family, which was on the other side of the stage, and with their very attractive crown princess that my son decided he wanted to meet. But in fact, it turns out she has a boyfriend. And then the king presents the medal, which is in that little box. It looks kind of like this, but it doesn't have a ribbon. People suggest I drill a hole in it to put a ribbon in it, but I haven't done this yet. And I got a very nice congratulations from my wife. You see the medal in the front and the statue of Alfred Nobel looking over our shoulders. So what does this model really do? Well, one thing I find is useful is to think about it as trying to predict a confidence interval for what the stock market is going to do in the future. That is, what do you think the best and the worst are likely to be for what the stock market is going to do tomorrow? Can we form a bound that we're pretty sure the market is going to fall within that bound? The lower part of the bound is actually a very commonly used measure of risk. It's what's called the value at risk. The upper part might be viewed as your sense as to what the best possible outcome might be in the next day. So here I have a picture of, in red, the Standard & Poor's 500 returns over the last, I don't know, 18 years, something like that. And every day calculate the 3 standard deviations as predicted by the Arch model. When I multiply it by 3, I get the blue line. When I multiply by -3, I get the green line. So you can ask, how often does the stock market lie outside of 3 sigma? That is 3 standard deviations above or below. And what you see is that almost all the time it stays within this band, but more interestingly, the bands change over time. And you can see periods in the middle 90s, between 92 and maybe 95, when the bands were very tight. The stock market had relatively low risk in that time period. And then we had the internet bubble, and the volatilities went up, and the risk went up, and the markets became, the confidence bands got much bigger. And then after the recession of the 92 was over in the spring of 93, you see the volatilities coming down, and the bands got narrower and narrower, and we have this famous period from 2003 to first part of 2007 when volatility was extraordinarily low, much like it was in the early 90s. And a lot of people think that that's important in understanding what's happened since, but you can see it so clearly on this kind of picture. And then when you get to the right-hand side, and I think this only goes up maybe through beginning 2007, or maybe the end of 2007, you see the volatilities increasing, and the risk going up and confidence bands getting bigger. And so we're getting a pretty good picture of the risk by using this Garch model, looking one step ahead, each step as you go. In fact, there are some 3 sigma events over this long period. There is one that's -6 sigma. That was in 1997. And there are a few more extremes than you would expect from a normal distribution, but we all know that the stock market doesn't look like a normal distribution. It has more extremes, fat tails, and so it's not an abnormal number of extreme events at all in here. But the question that you'd really like to know is, if we use this model through this current financial crisis, would we have actually had the same sort of performance where we had reasonable kind of confidence bands? And could I have done this in advance rather than just looking backwards? So what I'm going to show you next is a model where I've estimated the model through 2004, or I guess it's 2003 actually, and use the parameters, and then every day, one day ahead, you calculate what these confidence bands ought to look like, and then see what happens. So you can I'm only looking one day ahead, so it's not a very long horizon risk, but what do you see? Well, you see a very different looking picture. You see the low volatility period here, and this is all post-sample now, this low volatility period, and you can see the volatility starting to increase in 2007, and then in last fall we see this dramatic increase where the standard deviations go skyrocketing. I gave a talk like this in Cuba a few weeks ago, and they said, "Oh yes, I know what that is." Really, what is that? That's the end of capitalism. But in fact, the bands are now coming down again. So it's not so clear that it's the end of capitalism. Seems like capitalism is surviving. In any case, you see that there are no 3 sigma events in this period, that these models actually, if anything, are a little bit too conservative in the predicted volatility as you go through this period of high turbulence. In fact, here is what the returns look like when you divide them by their standard deviation, and this would be a bell curve if everything was normal, but it looks kind of like that anyway. It's just it has a little more fat-tailedness to it, and the biggest extreme is an unheralded data point. Not Lehman, not Freddie and Fannie, not Bear Stearns. It's February 27th, 2007. This point right down here. And that happens to be the day that the Chinese government raised the tax on transactions on the Shanghai exchange, because they were worried there was a bubble in Shanghai. The stock market had gone up so much that they wanted to slow down trading. And the entire world, financial markets, collapsed as a result of that. Now, that collapse only lasted a couple of days because people sort of realized this was not a fundamental change. But it came in a time when volatility was so low that this was the biggest multi-sigma event in this data set. So, in a sense, this model, as a model of risk, performs pretty well through this turbulent time period. Why does it work? And why is volatility sometimes so high as what we've seen? You know, this is the conventional wisdom. It's got to do with all of us sitting there trading without any information, making crazy things happen to the financial markets. But what I would encourage you to do is to think about another answer to where volatility really comes from, which is based in more of an economic model of asset valuation. After all, when we buy a share of stock, why do we buy it? We buy it because we think its future earnings are going to be enough to make it worth paying the money today. And so we are doing a long-run forecast of the future profitability of either this company or this country. And when we do that, we are using every shred of information we can find. And you may say that you and I don't do that, but there are analysts that are using every shred of information, and major money managers and pension funds and so forth, and hedge funds that are busy doing this. So what moves prices is new information. And so every moment of every day, there is some shred of new information. And sometimes it's really important information, and sometimes it's not. But if it's really important information, the market moves a lot, and we see high volatility. So another way to think about the high volatility is we are having an incredible amount of information coming at us. And I think if you think about reading the newspaper last fall and hearing about all these banks that are possibly going to be nationalized and global recessions, you can say, I have never seen as much important news in my life. It is altering the way I see the future every day. One day I say it's going to be okay, the next day I say it's not. There's the source of that volatility. And it turns out that news does tend to arrive in clusters, which is why we get volatility clustering. So let me show you some pictures now that we've talked about what really we think is going on. These are pictures from a website which we have at Stern now. It's called the VLab, or Volatility Lab. And I have an institute called the Volatility Institute, which hosts the VLab. And so what this does is it calculates volatilities for a lot of different assets every day. So this is from yesterday. And so I'm going to give you pictures of financial market volatility for a variety of assets every day. And if you want to do it yourself, any day, and I encourage you to kind of pay attention by going to this website periodically to see what volatility is doing. And if you don't remember websites, and I never do, you can Google VLab, and if you're not careful, you'll get some technology lab at MIT. But if you do VLab NYU, you'll get it, or VLab Engle, or something like that. So what do we see? Well, here is the S&P, and what you see in red is the level of the S&P volatility over the same period that we've just been talking about. And you see it jumps up to almost 70%, which is a really big number, whereas on average it's about 20% over this period, and at the lowest it was around 10%. So it's now been through this period of extremely high volatility. On the bottom in green is the level of the S&P, and in the blue is the change. And the name volatility clustering can be seen when you look at the blue curve. It's periods when the amplitude of the stock price moves is very large, and then other periods the amplitude is small. Looks a little bit like a radio wave or an EEG or something like that, but that's the volatility picture. This must be wanting me to do something else. Okay. You can this is now just looking at the last year of it, and mostly I'll show you just a year. You see the high values here. What's plotted on here also is the volatility index is calculated from options prices, the VIX. You may have heard of it called the fear index, and it's a way of measuring what the options market thinks volatility is going to be. And you see that moves pretty closely with the Garch volatilities. If you look on the next, I have a new measure of volatility which uses the daily high-low range, and that many people think should be more accurate, although it seems to have exaggerated the volatility in October, because I think the financial markets had some peculiar behavior around the close for many days, which probably exaggerated the range over what the volatility really was. If you look at corporate bonds, you see that using 4 different ratings qualities, AA, BAA, B, and C, that the volatility that happened starting mid-September affected all of them, but it had a much bigger effect for the lower rated bonds. And this is why we call it a credit crisis, because low credit corporate bonds ended up having a dramatic change in their prices, and you see the green and the blue curves showing very high volatility, which has pretty much come back down again, although there's a little spike up right at the end on C-rated bonds, and I think that has to do with Chrysler's bankruptcy last week, because this is as of yesterday. Oops. If you look at currencies, you see a picture. It's not nearly so dramatic, except for one on this scale, which is the Korean won. And you see that that had a volatility which skyrocketed last fall, but the euro and the British pound and the Russian ruble are the other ones that are plotted on here, and they have increased to some extent, but don't show the same dramatic increases that we saw in the equity markets. Commodities are also very interesting. In red is the volatility of gold. I don't know what any of you are gold bugs, but there's many people that have decided in face of this high volatility, you wanted to move to a safe asset like gold. But it turns out, of course, gold has volatility too. Oops. Let's see, what shall I... Should change your battery, switch to a power outlet. Do you have power in this? Okay. So here we have gold in red, and you see its volatility went up. It went up from maybe 20% to 40%, which is a substantial increase, but nothing compared to these other commodities, which are energy commodities and metals and mining commodities, and gas and oil, which showed very dramatic increases in their prices. But it's still true that gold volatility did increase. Looking at the world as a whole, here's the global MSCI World Index. And I should point out that most of these are measured using ETFs. I'm using exchange-traded funds so that they're all timed with the U.S. market, even though they might reflect a foreign basket of assets. Emerging markets showed this volatility which exceeded 100% last fall, but has now come back down to much more normal levels, 20 or 30%. This is the MSCI Emerging Markets Index, the BRIC, which is Brazil, Russia, India, and China, and Mexico, which is in blue, which is a little higher and has spiked up recently because of this, probably because of the swine flu. So you can see a lot of the kinds of events we read about in the newspaper in volatility patterns. In European equities, it turns out the Swedes have the highest volatility, but I guess I don't have Italy there, but Italy has spiked up recently, and so see a pattern on it. Okay, one more thing to show you is correlations. Because not only do volatilities change over time, but the correlations between assets change over time. And we calculate these, again, in this website using a couple of different models. And this is a picture of correlations across sectors between, say, energy and finance and consumer discretionary services and technology and so forth. The red curve is the average of all the pairs of correlations. So there are about 10 sectors, so this is like 50 correlations. This is the average. And then there are a couple of specific ones that I plotted on there, which are the energy correlation between the energy sector and the financial sector. That's the middle one. And the bottom one is between the energy sector and the technology sector. Again, these are ETFs. Actually, I guess the bottom one is energy and finance. And you see that all those correlations show this interesting feature is that they were relatively low last summer. But when the shoe dropped and Lehman went bankrupt, all the correlations shot up to a much higher level, higher than they have been historically for a long time. So think about what this means. It means we had some sectors that were doing well, some that were doing badly, and we knew that, right? We knew energy sectors were actually doing great for a while because the price of oil was so high. We knew that the export sectors were doing well. Technology was doing well. Housing was doing terribly. Construction was awful. Banking was awful. But in September, they all moved together. So this economic pattern changed dramatically last fall. It changed to a situation where the entire economy, almost without exception, there are very few firms that are seeing good news. Very few states and regions are seeing good news. It was bleak for everybody. And the same story is true internationally. This is looking at the average correlation across a whole bunch of different countries. And you see that shot up in August as well. Some countries thought they were going to avoid this recession because it was made in America, but in fact, everybody is feeling it. And we see that they've stayed pretty much high. There's some decline that we've seen. Okay, so, I mean, that's a lot of pictures. I'm not sure exactly what you get out of it, but the patterns are pretty dramatic. This event we saw last fall is one we're going to talk about for a generation. And economists are going to be trying to understand what all the components are, what are all the ingredients. But the volatility is one of the real signatures for what was going on. So what we're seeing is that volatilities are coming down in almost all asset classes. They're still high. They're still well above any kind of notion of what the long-run normal volatility is, but they've come down dramatically since, well, early December. Some with some spikes up in January and February, but mostly they're down. So what do we think is going on? If we think that news is really the source of volatility, then can we understand these patterns? And there are two things that I'd like to say about this. One is that a big source of volatility is macroeconomic uncertainty. When we don't know what's going to happen to the macroeconomy, we don't know how to price our assets, and every piece of information moves them a lot. Secondly, we have credit problems, and these credit problems are particularly associated with securitized debt, and these also have led to incredible amounts of volatility, but it's a little bit of a different story for how those work. And I'm not really going to talk about those today, but I would encourage you to look at a new book which Stern faculty have spent last fall working on, called Restoring Financial Stability. And it has a series of 18 white papers in it talking about different aspects of this financial crisis, from housing and mortgages to over-the-counter markets and derivatives and regulatory apparatus, and a couple of interesting new proposals for regulatory taxation schemes, and just a lot of different things in this book. What I will say just a little bit about is the macroeconomic uncertainty, because we're all sort of macroeconomists a little bit. We watch the economy, and the question you like to know is what macroeconomic events are associated with high volatility. So Gonzalo Rengel and I wrote a paper last year where we took data from 50 countries and calculated the equity market volatility for all 50 of those countries, and then tried to correlate the countries and the time periods with high volatility with macroeconomic information that we had. And essentially, this is a big panel data set. Those of you who are econometricians know that there are a lot of issues there, but I'm just going to focus on the economic issues, which is, what did we find? It turns out that the countries and the time periods with the highest volatility had one or more of these characteristics. They had high inflation, slow output growth or recession, high volatility of the short-term interest rate. That means the short-term interest rate was moving around a lot. High volatility of output growth and high volatility of inflation. So not only the level of inflation, but also its volatility are important. Not only the rate at which the economy grows, but also its volatility were important. So when we look at the U.S. or the global economy today, we see number two is really important. Are we going to have a mild recession? Are we going to have a deep recession? Are we going to have a Great Depression or a lost decade like in Japan? When we look at the volatility of short-term interest rates, we see that interest rates went from 1% to 5% back to 25 basis points for the short-term rates. There's a lot of volatility in the short-term rates. And there's a lot of uncertainty about output growth and whether, in fact, all this spending is going to really produce inflation in the future. So most of this list is pretty relevant for us today and explains, I think, why we shouldn't be too surprised that we have high volatility still in the equity markets. But what about the low volatility period that we just had? I mean, in some ways, that's a big puzzle. And I gave a lot of talks on why is volatility so low. And most people thought that we shouldn't expect it to be so low because we had massive budget deficits, a balance of payments deficit, expensive war was going badly, Chinese ownership of the vast U.S. debt, high energy prices, and possibly too many private equity and hedge funds. So these are all factors which kind of feed into this macroeconomic instability, if you like. Some of them are more specific. Some of them have been given a big important role in understanding today's credit, the long-term capital flows. But we found that financial market volatility was very low during those 3 or 4 years, in spite of all these events. And what's the explanation? Well, the explanation, I think, is that there was a term structure of volatility. The short-run volatility was low. The long-run volatility was high. And you can see that in the options markets. And, in fact, most people thought it was the case, that the low volatility was not going to last, that it was going to rise. And so were we prepared? I mean, I guess not, right? Okay. I have a little peek at the Great Depression, which I was going to give you, but I'm a little worried. I'm running late. I've kind of lost track of where we are time-wise. This time? Okay. So there are 3 volatility events that we might be interested in comparing. One is the 30s, and this is now a plot of the Dow Jones return since 1928. You know, we don't usually look at that kind of long sweep of history. This is like 20,000 days. It's a lot of data. But you see the volatility clustering incredibly clearly. Wide volatility there and smaller, big bands. And you see the crash of 1987. I don't know how many of you were born yet, but anyway, it was a big event for most of us, and that's the biggest single event on this data. So what's the relationship between these? Well, if you look in the 30s, here's the decade of the 30s. The level is shown in green, and the Hoover administration inauguration is red, and FDR, Roosevelt's inauguration is in blue. So you see that the stock market actually crashed dramatically during Hoover administration, and we talk about that a lot, you know, that we didn't really have good theories as to what we should do about it. And then after Roosevelt came in, the market recovered to some extent, and then had a subsequent decline later. But if you look at the volatility, you see that there was substantial volatility after the Roosevelt administration, and I think some of that volatility is due to the new and innovative policies were put in place that people didn't know whether they were going to work or not. So in fact, new policies themselves are likely to produce financial market volatility because we don't know whether they're going to work. And I think that's another component of understanding this volatility. It doesn't mean we shouldn't use them, but it does mean we have to recognize that there's a lot of uncertainty around them. And we all hear every day in the newspaper about the uncertainty about, you know, whether the stimulus package is going to work, whether the TARP, whether we're going to be able to buy these toxic assets, whether the public-private partnership is going to work, how about all these Fed guarantees that are being put, you know, all this stuff. And finally, you see there's a blip, an increase in volatility in 37, which is really associated with when Roosevelt thought we were out of the woods and started and raised taxes, and it turned out that the economy nosedived as a consequence. So the exit strategy is very important and needs to be carefully thought about. 1987, we had extremely high volatility. The Garch volatilities hit 140%, but it was very short-lived, and it doesn't look at all like the Great Depression. And it also doesn't look at all like what we've seen today. This was really over in about a month, even though it was an enormous shock to the financial sector. And what can we expect for this time? Which one of these two stories are we talking about? Or, of course, neither of them. Well, is this the story? Or is this the story? This was better before the election, when you couldn't imagine Obama and Palin dancing, but anyway. So you've seen this picture, and we don't know what's going to happen, but it is coming down. Do we have another spike of volatility? We could. It could really happen. It doesn't seem like the major problems are all resolved. On the other hand, financial markets are looking forward, saying, we think things are looking better, and its stock prices are creeping up day after day, and volatilities are coming down. That's, I think that's a lot of people's market view. There's also a view that the institutional traders have not come back in because they don't think that the problems with the banking sector have been solved yet. The stimulus package is not actually in place yet, so we don't know whether it's going to provide a big boost to the economy. So there's a lot of uncertainty still, but I'm only going to leave you with that question. So my final remarks are kind of speculative, which is all these risk measures are short-run risk measures. The value at risk in the Garch models are talking about how risky the market is going to be tomorrow or the next day. But when we talk about macroeconomic risks, we're talking about something that's a little further in the future. What is the economy going to do over the next year? But once we've started talking about things that are further in the future, maybe we should talk about things a lot further in the future, because those affect financial markets too. And one example is war and terrorism. Do we think war and terrorism is a long-run risk? Well, I think it is, actually. This is the way we got out of the Great Depression, was having a war. Is there going to be pressure to have another war? Are some of the countries that have incredible economic distress going to find that war is a better option? Are we going to find that terrorism, which grows from poverty in many cases, is likely to be on the rise? These are kinds of long-run risks that we perhaps should worry about. What does it mean if we have a long-run risk? It means that investors may think that the stock market is not as good a place to put their money as if these long-run risks weren't there. A cautious investor who's worried about the long-run risk of terrorism and war might keep his money in a safer asset than in stocks. And consequently, some of the lower price we see in the stock market could be due to these kinds of long-run risks. So long-run risks would increase the cost of raising capital. It reduces the income of entrepreneurs and costs jobs. What should you do about it? Well, anything that reduces the long-run risk would actually give a benefit to the stock market actually today. To valuations could go up by just reducing these long-run risks. And so I think it's important for us to recognize that some of the effects of this recession are reduction of trade, reduction of lending across countries, and it's very important that we don't lose sight of the fact that this is a global economy, and if we separate and become too individualistic, we are not going to have the benefits of global cooperation, and it's going to increase the risk of war and terrorism. If we can solve this, we can have benefits today, even though the war that we're worried about is in the distant future. In fact, if we're worried about the distant future, we talk all the time about global warming. What about global warming? Does that affect the stock market today in the same kind of way? Potentially, yes. Potentially, yes. Many of you are young. When your working age is when the global warming crisis is going to become much more serious. And there will be presumably taxes that you'll have to pay. You'll have to buy products from companies that have to do mitigation. They may have to move locations, may have to build dikes against the sea, worry about extra hurricanes or all these things that Al Gore is talking about. It seems to me that it's very likely that it's going to be more expensive to live and to do business in 20 years as a result of global warming. It's also likely to be more expensive because of your obligation to support us through Social Security and Medicaid and these various public retirement programs. So if I were a young person today, I'd be pretty worried about these kinds of long-run risks and trying to figure out what to do about them. And so I think one of the things we might look for is a solution that we could think of today. So what is the solution for today? $4 a gallon. That seems to me is a pretty powerful solution. And how would we do that? Well, I think most economists are in favor of something like a carbon tax. And a cap and trade system could be an alternative, but it's unlikely that it's easy to put in place. If you have a comprehensive carbon tax, then it will encourage energy substitutes. We're not going to have to substitute windmills anymore. They would then be profitable on their own. And if it's comprehensive, you can be very happy for everybody that avoids this tax, because it means they've bought a fuel-efficient car or insulated their house. And so my explanation for why a carbon tax is not even on the table is because it's got the TAX word in it. No political party can afford to be ridiculed as a tax party. And so I think you could solve that problem by talking about the revenue side of it. And in fact, my suggestion, which is not received much traction, would be that you take this tax revenue and you divide it by the number of people in the country and you send everybody a check. And you do it even before you get the tax revenue. So people have money, they know that the cost of energy is going to go up, they can buy a fuel-efficient car, insulate their houses, move to a location closer to where they work, and actually accomplish all these things even before the tax is fully in place. It would be a stimulating kind of a policy, and it would be revenue neutral. So climate change policies don't have to be expensive to be effective. And then I would think after the recession is over, you'd probably want to use this money in a separate fund, like a sovereign fund, to support the long-run public costs like Social Security. So by putting in this one tax, you actually make a big dent on the social entitlement programs and the climate all at once. I think we missed a chance to keep energy prices high. Did we miss this opportunity? In a way we have, but maybe it's not too late. So let me just conclude to make sure you take only the risks you intend to take. Keep an eye on the long-run risks, and remember that if you can solve a long-run risk today, you get the benefits today. You don't have to wait for the long run. It's not for the next administration, it's for this administration that you get these benefits. A little bedside reading, anticipating correlations. If you have a hard time sleeping, this would be a great antidote. And if you don't know about the Society for Financial Econometrics, it's a new global society which is very interested in volatility models and risk management and many kinds of statistical models in finance. We're having our second annual meeting in a couple of weeks. It'll be in Geneva, and so I encourage you to do that. So my favorite cafe is the Arch Cafe, and thank you. I think the correlations will go back down again, and you'll see, some winners and some losers. I mean, I don't quite know how to call those winners and losers, but I would think that that's exactly what should happen. And I think this happens within sectors. I mean, I'm expecting in the banking sector we're going to see some winners and some losers, not just the banks are going up or the banks are going down. We should see some of them really having to downsize and some small banks stepping up to fill the place. So I expect to see the correlations coming down, and I'm sort of surprised they haven't, even though the volatilities have come down. The correlations haven't moved too much yet. Yes? How much do we look at the actual news? Well, you're asking a hard question, which is, if I say I think it's the news that makes volatility, you say, what about the news? Which piece of news is really doing it? How much news does it take to get volatility up to 70%, which is what we saw in the fall? We're starting a project to try to look at that, but I don't really expect it to be possible to answer that question, because every news event is different. You see earnings announcements coming out from companies, and you look at this earnings announcement and say, this is good news, and the market goes down. Well, why is that? Well, because they were expecting something better than that, or because there is another paragraph that you didn't read about the forecast for the next year. And so each piece of news is nuanced, and that will depend, actually I don't think we need it anymore, and it will depend on the environment, how important this news is. So I think the answer would even if I could give you the answer on average, it wouldn't be the same in the fall of 2008 from the spring of 2009. Yes? I think it would have been a lot worse, actually. I think that much as some of this is distasteful to us, I think it was necessary. I don't know whether all of it was necessary. Some of the pieces of this seem not to be working very well, but I think as a whole, it looked like if they hadn't bailed out Freddie and Fannie, I mean, that's asking the other side of the question. The question that most people want to know is, suppose they had bailed out Lehman, what would have happened? But if they hadn't bailed out anybody, it would still have been, Lehman still would have gone under, and I think you would have seen, you know, Merrill and WAMU and Wachovia and all those banks would have had to have been taken over by FDIC, I think, because their stock markets values for all those were on a steep decline during that couple-week period. And I think it would have been made worse by not taking over Freddie and Fannie. I mean, in some ways, taking over Freddie and Fannie was not as big as the rest of it, in the sense that they always had sort of an unspoken guarantee, but no one knew for sure whether when push came to shove, whether the government would actually do it. And so it wasn't a surprise that they did take them over. I think Lehman was the big question, and AIG was a big question. What would they do with those?
How would you have answered this? Should the government have bailed out Lehman based on what they did for AIG?
Well, I mean, as I said, I think people were going to spend a decade talking about all this. My feeling is that if they had bailed out, and I was in favor at the time of letting Lehman go, and it was really because I thought that if you look at these signs, it looked like we were doing better. And I think actually the Fed had that opinion as well, that over the summer it looked like we'd recovered from the Bear Stearns event and the economy was mending and could perhaps take this. But suppose they had bailed out Lehman, I think it would have just been the beginning, because all these other banks were still in trouble and they were lined up. And you'd have had Morgan Stanley and Goldman, which were close to going under the next week. I don't think if you'd bailed out Lehman, it would have made them look that much better. What about Merrill? Would Bank of America still have bought Merrill? I don't think they would have, and so Merrill Lynch would have been a sort of a wounded player out there. And I think it just would have gone from one to the next to the next. And it depends, of course, what you mean by bailout, Lehman, whether you're bailing out the bondholders as well as the shareholders, or you wipe out the shareholders and preserve the bondholders. I mean, it's sort of complicated how that happens. If you let the FDIC do it, then everybody gets a cut, loses some substantial amount. I don't know.
Your overall assessment of how the administration is doing in terms of handling the economy and how the Fed is doing?
I give them high marks for being innovative. I don't give them. I give them high marks for most of the programs. I don't think all of them have been successful, and I think that the net effect is that they have absorbed a great deal of the risk that the private economy had previously taken has been shifted to the government. And so the taxpayers are holding the risk. On the other hand, I'm not sure that's terrible, because these risks are risks that are going to be paid off if the economy really goes down. And that's exactly when you expect the government is going to have to go to its deepest pockets that it's got. And so, except for the fact that taking the risks is distorting, I think it makes sense for the Fed to take on these kinds of systemic risks. So basically, I give them pretty high marks. I think some of the programs are not going to work that well. I will not be surprised if there are no toxic assets that are sold to the public-private partnership. I think that program has actually delayed the ability of people to sell their assets, since no one wants to reduce the price they're selling them for or raise the price they're willing to pay for them, as long as the government is standing there with a pocket of money to make these connections. So that market has completely stopped waiting for this to happen. And I won't be too surprised if Geithner also decides, just as Paulson did, that he couldn't do it. I think that's a pretty interesting point. I don't know whether it's true that nobody is. I know some of the investment banks have worried about, I don't know whether security is the right word, but they've worried about the safety of their operations and have backup facilities elsewhere, which must be an incredible expense for avoiding this risk. And the only story that I know that's related to this is a couple of years ago in an event called the Russell rebalance, which is when the Russell 2000 changes its names, and all the people that are indexed to the Russell have to sell these 100 names and buy these 100 names. So there's a whole lot of trading that happens without any really economic information. And so there's lots of volume. A lot of people are sort of gaming it, waiting to the last minute and so forth. The exchange went down. On the last day of the Russell rebalance, I think NASDAQ computer went down or something. So anyway, a company that I was dealing with at the time had fax machines all set up in case this would happen. And so they were able to fax over all the orders that they needed to do, and felt like they actually did very well. So that they did have some eventuality, some contingency like that in mind. And I don't know how many banks, investors, whatever, have contingencies like that, but I think it's a very good question.